Would you take $1 million right now or one penny that doubles every day for the next 30 days? Quick decision. Most people grab the million. And that's exactly why most people don't understand how money actually works. Because that tiny penny by day 30 is worth more than $5 million. You heard it right. Yes, $5 million. Let me show you why this matters. Day 1, it's just 1 cent. Day 2, 2 cents. Day 3, 4 cents. Day 10, around $5. Looks pathetic, right? Day 15, around $320. Still unimpressive. Day 20, over $5,000. Now it's getting to something. Day 25, over $160,000. Day 30, more than $5 million. Same penny, same rules, just time. At first, nothing seems to happen. Then suddenly, everything happens. That's compounding. But here's what actually stops people. You think about investing and immediately feel overwhelmed. Stocks, ETFs, index funds, recessions, market crashes, and underneath all that noise is actually the real fear. What if I lose my money? Fear. But here's the bigger risk nobody talks about. Doing nothing. If your money is sitting in a bank account, doing nothing, inflation is slowly draining it. You don't feel it day by day, but 5 years later, everything costs more. Your money buys less. If it's not growing, it's shrinking. Saving protects money. Investing grows it. In US, inflation roughly increases around 2 to 3% every year. Now here's the part nobody tells you. You don't need to understand everything. You don't need to predict the next big stock. You don't need to time the market. You just need 3 decisions. That's it, not 300, 3. And once you understand these 3, investing becomes simple. Let's break these 3 decisions down. Decision 1. When do you need the money? If you need the money in the next 1 to 2 to 3 years, don't put it in the stock market because short term markets swing hard. In 2008-2009, during the financial crisis, the US stock market dropped nearly 50%. People panicked, it felt permanent. But over the next decade, the market recovered. It not just recovered, it went on one of the strongest bull runs in history. Then in 2020, during COVID, the market dropped around 35% within a matter of weeks. Fear everywhere.
It's dropping too fast! Sell everything now!
But it recovered within months and then hit all-time highs. Crashes, they feel permanent, but history shows they aren't. If your time horizon is 5 years, 10 years, 20 years, 30 years, these crashes just become like bumps in a long upward journey. Let's get into decision 2. What are you buying? When you buy a stock, you're buying ownership in a company. If you buy Apple stock, you own a small piece of that business. If the company earns more money over time, its revenue numbers grow, your piece becomes more valuable. That's what a stock is. But instead of buying one company, you can buy a basket of companies. That's called an index fund. One of the most common examples is the S&P 500. S&P 500 tracks 500 of the largest publicly traded companies in the US. These are some of the biggest and most profitable businesses in America. Companies like Apple, Amazon, Google, Microsoft, Nvidia, Tesla, all are part of this S&P 500 index. Instead of betting on one winner, you own them all. You diversify. Historically, the S&P 500 has averaged around 8 to 10% returns on an annual basis over long periods of time. Not flashy, but powerful. Even professionals struggle to beat it consistently. So beginners don't need complexity, they just need consistency. Decision number 3. Where do you invest? If you work in the US, your employer might offer a 401k match. A 401k is a retirement account where you invest money directly from your salary or from your paycheck before taxes. Often, employers match a portion of what you contribute. That's free money. If someone offers you free money, you take it. Then there's a Roth IRA. A Roth IRA is a retirement account where you invest money after taxes. The benefit of a Roth IRA, the investment grows tax free. And when you withdraw in retirement, you don't pay taxes on the gains. Over decades, that tax free growth becomes extremely powerful. You can use a regular brokerage account for flexibility. The platform matters very less than starting. And there are multiple platforms: Robinhood, Fidelity, E-Trade. And many people think you need money to start. You don't need hundreds or thousands of dollars to start. Many platforms let you start with just $50, some even with lesser than that. But before investing, you need to make sure of these 2 points. You pay off any high interest debt and also build a 3 to 6 month emergency fund based on how much your expenses are every month. Then automate investing. Monthly, boring, predictable, that's the secret. Now let's go back to the penny. So in the beginning, it looked like nothing. So does your first $100. So does your first automatic payment. But compounding rewards patience. If you invest $1,000 starting now in S&P index and assume a 9% return for the next 25 years, your total investment will be worth more than $1 million. So compounding rewards patience. The people who win with money aren't geniuses. They just start and they don't stop. They are consistent. Investing isn't about getting rich next year. It's about giving your future self options: freedom, security, choice. So I'll ask you again, tell me in the comments, what's actually stopping you? And if you want simple, no hype investing, explained clearly, stick around. Because wealth isn't complicated, it's discipline. Thank you for watching. Please like, share, and subscribe for more such videos.